Good day, everyone. Thank you for joining us once again here at Seafried and Brew for our economic briefing. For this week's briefing, we want to review over the third quarter performance of our community bank benchmark group. And when we look at that group, you'll notice that we have that as banks with assets between 100 million and 5 billion. And that's the group that we use when we do our comparisons to individual institutions in our reports. Now, when you look at this group, the overall level of return on average assets continues to improve. We are up to 1.18% for the third quarter, up from where we were last quarter at 1.14 and a year ago at 1.04. So we continue to see this improvement in returns. And when we look at them on the individual basis of our subgroups, and we look at the subchapter S, group up at a 1.52, continue to see that improvement year over year as well as quarter over quarter. Our stock group at 1.11, so we continue to see that improvement, and as well as our mutual institutions up to 0.67. So we continue to see that that mutual group continue to improve in their performance, as we've seen in the other groups as well. And that's important to note because the mutual groups have a different business model, but we can see that they continue to show that improved performance. When we look at the overall level of net interest margin, we can see we are up 4 basis points from last quarter up to 3.84. We continue to see this expansion from where we were in the first quarter, and we are above where we were last quarter last year at that 3.82. Now, a lot of things that are built into this, but overall, when we look at the level of earning assets, this continues to improve up to 4.47% on that yield on earning assets. And then we also look at the cost of funds, which has escalated in here to 71 basis points for the third quarter. We can see the level of changes has increased in that third quarter, and we predict that this is going to continue to happen as we move throughout the next 12 months. This level of increase should get steeper and steeper on that cost of funds with the renewal and repricing of those deposits. In terms of the loans to assets, we see we're at loans to assets of 71.05. We continue to see increases in this number, and now we have breached the level of where we were in the pre-financial crisis. So we've gotten to that level of loans to assets as we were prior to that financial crisis. So it's 2008 and beyond. With that, we can see the overall aggregate quarterly loan growth actually reduced down, still a positive, but under that 1%. And we'd have to go all the way back to 2013 to see a growth period of that below 1%. So that's at about 94 basis points. So we see this loan growth start to slow down in here. So it'll be interesting as we look into the fourth quarter and then into the first half of 2019 to see if this continues with this slower growth in that loan portfolio. That could lead to an overall reduction in the overall net interest margin. That compounded by the fact that the yield or the cash type deposits of total deposits ratio has seems like reached the limit there in the first quarter 2018 at 72.63, and now we're down to 71.74 in the third quarter. So you see this downward trajectory. We're starting to see these non-interest deposits roll off, as well as the money market and savings starting to roll into those higher priced CDs that we're seeing out there. And that, of course, is impacting the interest-bearing deposits and their cost. And now we're up You can see where we are, 71 basis points last quarter, 82 basis points this quarter, up 11 basis points. That trajectory getting steeper and steeper, and we anticipate that would escalate as we move into 2019 and then throughout 2019, that to get steeper quarter over quarter changes. That's going to have a direct impact on the cost of funds increasing, and then overall level of net interest margin. We could start to see that tighten in here in the latter half of 2019. When we're looking at overhead though, overhead seems to have stabilized. We're down here at 2.09, similar to where we were last year in the third quarter, and we had just a little bit of a spike, but the overall the level of net interest margin is moderate, and this is made up of both the yield or the non-interest expense and non-interest income numbers. And we can see non-interest income at 56 basis points, right around where it has been over the past 5 quarters, and non-interest expense at 275. Good benchmarking numbers that we want to compare your institutions to as we go through the next couple of quarters here. Tax burden down to 16.7% for the group in its entirety. When we strip out those subchapter S institutions and just look at the stock and mutual institutions, we can see the average rates around 22% for that tax burden. So that's kind of where you want to be in your tax burden, or a little lower. An institution that is very efficient at managing their taxes would see a ratio of about, or tax burden of 16% or below. When you're putting on those tax exempt loans and credits, and then also those tax-free municipal bonds. When we look at the total risk of the institutions in this bank group, we can see quarter over quarter we had just a slight increase in risk, still in that lower moderate zone in our scoring system. And year over year, very little change. So while we've seen this increase in overall earnings and the return on earning assets, we can see that the overall level of risk really hasn't increased that much. So overall, we're making more, and yet the risk on our balance sheet has been unchanged for the most part. So we look forward to talking to you next time. Have a great week, everyone.